Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. October is National Financial Planning Month. Financial planning, as we know it now, includes investing, tax planning, retirement planning, and basically other ways to get your finances in order and create mindful budgets to ensure a safe and secure future. Getting a step ahead of your spendings and finances is beneficial in the long run, and Financial Planning Month is a perfect time to do that. Joining us for this segment, we have Seth Wunder, Chief Investment Officer over at Acorns, to discuss market performance in bull and bear markets and what dollar cost averaging can do for your money. Seth, it's great to see you as always. Welcome back to Trade Talks.
Yeah, thanks for having me.
How has the S&P 500 performed in bear market cycles?
You know, what's interesting about bear markets is that by the time you enter a bear market, the S&P is already down 20%. And it has this negative connotation that more bad news is to come on a forward basis. The average down move in a bear market total is about 35%. So by the time people start talking about a bear market, you're already statistically more than halfway through the down move. And if you look at it after a bear market, so just remember that every bear market in history has ended with a higher high. The average return from the time a bear market starts, which this year would be mid-June, is almost 10% 1 year later. So the vast majority of the time it's flat or higher, but the bear market move, it goes in that cycle pattern based on history.
Do bull markets return more than bear markets lose?
Yeah, I'm glad you asked that, because if you look at an investment over for a person over the continuum of bull and bear markets, the returns are actually quite phenomenal. So bull markets return dramatically more than bear markets. So as I said before, the average bear market pullback is about 35%. Bull markets, depending on how you measure it, you could look at it from the very low of the prior bear market, or you could look at it from just one high to the next. You've got somewhere between 100 to well over 200% returns. So if you think about it more as a continuum from the start of one bull market, and if you held it all the way through the end of another bear market, based on history, you'd have at least 40% higher dollar value in your account from the time you started. And so to look at them holistically, investors still win over the course of both cycles.
What is dollar cost averaging and what can it do for your money?
It does a couple of things. First off, remember that when people start to invest, one of the things that they normally struggle with is how much, and they feel like they need to make this lump sum investment. So dollar cost averaging is the process of making small incremental investments over time, as opposed to one lump sum. And what it allows you to do, and particularly in down markets or even volatile markets, it allows you to buy more shares when the market sells off. And so as you accumulate more shares when the market's on sale, it sets you up for better long-term returns over time.
All right, Seth, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.